If you have not watched swing trade video 1 to 3, you may do so before watching this video. Before continuing, I would like to say to traders that the video is for educational purposes only. It's neither a solicitation or an offer to buy or sell any financial instrument. It is primarily for the TSTW SYS 008 traders. In this fourth part of the video, we want to discuss, fundamental analysis, market watch, core value trading, important and essential, swing trading, knowledge that we must have so we can make excellent decisions. Many can swing trade, but few can swing trade successfully and consistently, all right? To achieve consistent winning trade, one must know, understand, and master, the swing trading, all right? One of the pages that I want traders to know, I have put some information here at www.dayprotrader.com. This is about core value trading. All right, you need to register for free. See here, say register now for free. We do not earn any money from being a member of our website. If at one point you do not want to be a member, send us email. What will happen? We will remove your name from the list. You may now go and check on Google on the search engine. You may still see some of your information like you are still a member, but you are not. You will take the search engine some time, to remove your detail from the website. By the day we receive, your information to remove your membership, we will remove your name. In fact, we do not send email to traders every day. The person who is benefiting from this relationship is the trader, because he or she will, come to our website and learn in their own time. The core value trading, this is what I call free, confidential or free proprietary trading tool. I was talking to traders about what is a G range, what is a Q range. These are my own proprietary swing trading tools to allow traders to, determine the profile of a financial instrument. The core value trading is valid for stocks, all right? So when a stock is released for the first time, the IPO price, from the IPO price, we can calculate what is the G range, what is the Q range. There are various data that we can calculate from the IPO price alone to know what the price is likely to do. You allow us to forecast or to predict the future of the financial instrument. So if you trade stocks, I invite you, and I also encourage you, we highly recommend traders to come here and click on core value trading and study for free this proprietary trading, swing trading tool or investment trading tool, so you may understand more about swing trading. There is another page here which we call Market Watch. This is what we have discussed in the swing trade video 3. This is about market leaders, market indicators. Apart from the market leaders, we also have market indicators. How do we use the market indicators? How the market indicators can influence a sector, can influence the market. So this is about understanding and knowing exactly what is taking place. Because as a swing trader, you want to remain in the market for 2 to 3 days or 5 days or more. Or as a position trader, you want to remain in the market for a longer period of time. As an investor, you want to catch the beginning of a cycle supported by a strong fundamental. So you want to know the core value trading, and you want to know what is a market watch. Do not consider yourself as a swing trader if you don't know what is a core value trading and what is a market watch. Talking about fundamental trading, ladies and gentlemen, 2 ratios trader must pay attention to. The first ratio is return on capital. The return on capital allows traders to select, investors, smart investors, to select the best stocks, all right? So this is the first ratio as a swing trader you must check. So a stock that have a higher return on capital. So if two company has 1 million capitals, but one got 10% return on capital, another one got 20% return on capital, the one that got 20% return on capital is a better company compared to the first one because both have the same, okay, capital, working capital, but the return on capital, the second one is higher than the first one. So the second company is a better company because with 1 million, he made 20%, but the first one made only 10%. So with the return on capital, we can select the best, okay, companies. That's only the beginning. The next thing, we want to check also the second ratio that trader must pay attention to is the earning yield. We want stock that with a higher earning yield. So the first ratio is a return on capital. The second ratio is okay, earning yields. The higher the earning yield, the better. But we want to buy stocks, okay, that has stock that have okay, higher earning yields, but stock that became cheap. So the stock that is stock with a high earning yield, but that is below its fair value, is more attractable for us because the stock has a high earning yield, but the stock for one reason, okay, is discounted, so to speak. So the price went down for one reason or another, or there was some crazy economy news that has distorted the price. The price went down big time, below its fair value, below the net asset price. So we know that this stock have a high return on capital. This stock has a high, okay, earning yield, but for one reason, the stock is discounted 75%, talking about Fibonacci retracement level, or 88%. We will be busy buying that stock, provided that the same management is in place and the same, okay, core trading strategy for that company is still valid. All right, the company is not crumbling under competition. The company management is still dynamic, making excellent decisions, adapting to the current economy environment. And talking about the trading triangle, the market itself is bullish. So we will be happy to load it, so to speak. We will buy that stock because it's an excellent stock, because the return on capital is high compared to the PLs. Okay, so we are trading a stock on the Nasdaq 100. We want to check the return on capital on this stock, compare them, check the best company that with the highest return on capital. We check also the earning yields. Now we want the stock to be cheap. This is about buying at the right time, at the right place, at the best price, where there is a value. We want to buy, as I said to you, the smart money want to buy low. So we want the price to go down fast. So once we filter out the best stocks, okay, excellent return on capital, excellent earning yield, we will expect the price now to give us a healthy pullback at a low risk point where there is a value. Best below its fair value, gorgeous, that we will buy if the market cycle itself is bullish. But this strategy will not be valid if the market is bearish. This is the madness of buy and hold, when traders will apply the same bullish strategy in a bearish season, and you will not work. There are a lot of things swing traders, position trader, investor can learn from farmers. You can sow corn, you can sow anything, but you want to sow it at the right season, at the right time. Sometime every month is not suitable for sowing. Sometimes it's a time for harvest, which means you take profit. All right, but we see some traders, they are permanent bull, they are buying even in the harvest time, and we can learn a lot from the farmers. Okay, so it's not all the time that you just go and look for return on capital or all these things, and then the next day you say all this is a mumbo jumbo and it doesn't work, because you want to align it to the environment. Okay, market is bullish, market is about to start a bullish cycle. Yes, we want to check everything, and now we want to align it perfectly so we can make excellent decisions. All right, so core value trading, market watch, return on capital, high earning yields, best price, best below the fair value or the net asset price. All right. The next thing we want to talk about in this video is about money management. You want to swing trade, you have many positions open, or you buy a lot of calls option. These are risks that you are taking. Now, we see all the time when it comes to money, traders are very, very emotional. And I don't take part into that with traders at all. I let traders to deal with their emotion alone, and I deal with mine alone. So when you're about to enter a trade, there is a rule that we apply, which is the 5% money management rules. So you cannot open, or if you open 100 trades, the total amount that you are risking must not exceed the 5% of your trading account. In case anything happened, you remember recently they were talking about flash crash, price market went down fast. You know, these days, these kind of things can mess up portfolio for people. Crazy news, just a rumor on Twitter has pulled the market down big time. There was another one in May 2010, market went down very fast, flash crash, because the more big market players are paying attention to the news, high frequency traders reacting to the news, you will see this kind of flash crash. And these kind of things, okay, can mess up a portfolio in a split of a second. To avoid this kind of nonsense, all right, you want to use the 5% money management rules. If the 5% money management rule is too high for you, you may use 1%, 2%, 3%. The most important thing is to manage the risk. So for instance, if for one reason your account is wiped out in one day, all right, you do not lose everything. You still have, okay, money to trade with the next day. A lot of swing traders can trade, but they do not have a big trading account. That's okay. But if you do not have a big trading account, do not open many positions. Take one position at a time, manage it. If it doesn't work, learn from your mistakes. If you go now to apply for a job with Goldman Sachs, somebody with PhD, another one with a master's degree, another one with just somebody that left college. But the person who left college has been trading for years, so he provided only his, okay, all right, how do you call level, A level, so to speak, in London. Well, he left college with A level, and he came to Goldman Sachs, and he came also with his trading account. He said, okay, I didn't go to school, I didn't go to university, but I've been trading for years. I trade stock, I trade forex, I trade, okay, many financial instruments over the year. This year I lost, another year I lost, blah, 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 blah. But I learned from my mistake, and I've been training for years, and this is the proof. Another person came out and said, okay, I'm qualified, I have master's degree, I've done this. They ask you, have you ever traded? No. Do you know what is trading? Do you know what is MACD? Do you know what is RSI? Do you know what is swing trading? Say, no, I'm willing to learn. That's not too bad. Another one with a PhD, say, I'm a highly intelligent person, I make important decisions in my life, I'm a smart person, I can learn very fast, I can adapt, understand the market, and I know the law of supply and demand. Great. But the person, listen, the person with more experience with trading is likely to be, okay, recruited for the job of a trader. What I'm saying here is that though sometimes traders are losing, are going through the motion of day trading, swing trading, making mistakes, they are improving their ability to trade, their understanding is increasing. So to avoid that, they work for nothing, or they spend most of their time trading without any gain, it's important for these traders to apply the 5% money management rules. It's very simple and straightforward. You allow traders, okay, to avoid the emotion. So when you have a losing trade, you don't go the whole day through the emotion. You don't get through, you don't feel too bad about it. You know that at least I haven't lost 5% of my trading account. By using the 5% of your trading account, you will have to lose 20 times. You have to wipe out your account 20 times before you are completely taken out of the market. Another thing that trader can do for swing trading, you may buy some position and hold them instead of using option. You may have a real portfolio when you buy and hold the asset in your portfolio. So market swing and ups and down cannot affect that portfolio. This is about what we call the dual swing trading strategy, which means one portfolio is high risk, which means you are using option, you are using spread betting, you are using binary betting, but another portfolio is a real stock which you buy Bank of America, you buy Intel, you have it with your bank, you are earning dividend on it over the year. this portfolio is there for you for years, okay? You give it a time for a long time. This is a long-term investment, apart from your swing trading, which is more a risky setup. All right? So the money management is so important when I start trading first. I can tell you now, to be honest, whenever I see a video on YouTube talking about money management, I don't watch it. I didn't pay attention to them. For me, it was like a waste of time. In fact, I didn't have too much money, and so I don't have to worry too much about it. But over the year, the accumulation of losses after loss after loss, I realized that if only I adhere to the 5% money management rule, I wouldn't have lost as much money as I did. Because what is happening, you forgive me to say this, all right? A lot of new traders will come into the market, which means they have some savings somewhere, some money somewhere. So they come to the market, they look at MACD, they look at the RSI, they look at the technical analysis, they look at Elliott Wave, they look at Fibonacci. It's very exciting. They look at the charting software. Everything looks beautiful. You want to be part of it, and you are addicted to it to a certain degree. Now, so with the money that you go, start pumping it, okay, you have a losing trade, and you have another winning trade, then you have another losing trade, then you have another winning trade, but you are losing more than you are winning. But because you are still in the market, you didn't realize that you are losing. But over the years, suddenly, you realize that you have lost a big chunk of your money. And now you get too emotional, you start wondering, how come I did not think of it, I did not pay attention, that I did not control, okay, the risk. That's why it's so important for traders that are coming to the market. Now that we see more hedge funds coming to the market, it's paramount for ordinary traders to become, okay, smart, to treat their trading as a business. All right? So in this fourth part of the video, we must understand clearly what is, okay, very, very important, what is core value trading. This will allow us to know what is the current, to know the profile of the financial instrument that we are trading. This will allow us to make excellent decisions. When Facebook came onto the market for the first time, on the first day that Facebook was released, we can quickly calculate and know the profile of Facebook stock straight away. This is about core value trading. We also want to understand, okay, what is the market watch, how we can use the trading triangle, what is a market indicator. Crude oil is a market indicator, gold is a market indicator, USD yen is a market indicator. How can we use these market indicators? The next thing that trader must know for swing trading, swing trade video 4, for traders that are trading, the core value trading is more for stocks. This is valid for stock only. I prefer that trader use it only for stock, for core value trading. For traders that are trading currency, you want to understand the correlation between currencies. So you see sometimes forex traders will buy euro, and we buy the euro USD, and then we go and sell the euro GBP, unless they are hedging their position. But sometimes traders do not understand the relationship between one currency pair and the other. I was showing a video to traders recently, and I was selling the pound yen. Okay, I was selling the pound yen, and the pound yen was going down. Okay, but then I was telling traders, look, if the USD yen start going up, that will have okay, a positive effect on the pound yen, which means the pound yen will start following the USD yen. These currency pair are called, my apology for the noise, these currency pair are, the pound is, we are comparing the pound to the yen, we are comparing the dollar to the yen, but if you pay attention to the dollar, Singapore dollar, the dollar yen, okay, the dollar Canadian dollar, these currency pair, if you are trading any of these three, you want to pay attention to the USD yen. All right? Because what is taking place, talking about hedging activity, which is another important point for swing trading, when the hedge funds are buying one financial instrument, they must hedge it. All right? So you are buying the euro USD, all right? They will buy at the same time the dollar Swiss franc currency pair. Though these currency pairs are negatively correlated, okay, because they go in the opposite direction, they will buy both together. So in case they are wrong, okay, they will, okay, recoup some of their loss. This is about hedging. So as a swing trader, you want to understand what is a hedging. So you open one position, you buy one financial instrument, you sell another financial instrument to hedge that position. Now, I will not go too long about the hedging activity here. I will just mention it to traders that as a swing trader, you want to apply, apart from the 5% money management rules, you must also learn about hedging. And this is valid for traders that are trading forex. Ladies and gentlemen, we can go on the whole day talking about core value trading, market watch, all right? Talking about return on capital, talking about earning yield. We can go on talking about the 5% money management rule, hedging, talking about swing trading. At the end of the day, ladies and gentlemen, the most important trading tool is the trader, the mindset of the trading style of the trader, and the financial instrument that the trader is trading. But there is something I want to leave you with before I close this video, is that whenever you are swing trading, you want to adopt the mindset of a farmer. As a swing trader, you want to swing trade at the right time, at the right place, sowing at the right season, and understanding also that there are times when one cannot sow, one can only harvest. We see it very often. In 2008, a lot of hedge funds went out of business. Why? Because they were busy buying and hold for a long time. Their strategy was completely wrong because the market itself was bearish. We are entering a bearish season. We are entering a harvest season, and people were busy sowing, and they were out. As a swing trader, you want to be careful. Whenever you are about to take a swing trade, pay attention to the S&P 500, pay attention to the sector, pay attention to the market environment, and use the 5% money management rules. If you like, you can also hedge your portfolio by put option to cover your call position so you can, okay, remain in the market for a long time. I've said enough, and I think you have learned something from it. Okay, we'll put into use, okay, to make excellent swing trading decision. If you think this is too much for you, just take it step by step. Until the next time, enjoy yourself and be very happy. We are the GSTWSYS 008 traders. This is about swing trade video 4.